Hello everyone. Today I will talk about the instruments of Indonesia capital markets. First, if a company needs money to grow, where does it go? Today I will explain the main of instruments of the Indonesia market, what each one means for investor and companies. Okay, number one is equity or stocks or saham bahasa Indonesia. When a company issues shares on the Indonesia Stock Exchange, it sells ownership stakes to the public or IPO. Investor buy stocks, hoping company grows and share price rises, and they may receive a dividends. Stocks are the primary way firms raise a long-term capital, and they offer investor both capital gains and ownership rights, but they come with market and business risks. Second, government bonds, often called treasury bonds or surat utang negara or obligasi. These are debt security issues by the Indonesian government to finance public spending. They pay periodic interest and return principal at maturity. Government bonds are generally seen as lower risk than corporate debt and are important for conservative investors and pension funds seeking predictable income. Third, corporate bonds. Corporate bonds similar like the government bonds, but it from the investors instead of giving up ownership. Corporate bonds usually offer high yields than government because they carry more credit risk, because they may leverage, and you can say utang, utang or credit. For corporate issues, bonds are a way to finance expansion without diluting shareholders. Fourth, sukuk and Islamic bonds. Sukuk are Sharia compliant alternative to conventional bonds. Instead of paying interest, they represent ownership in asset or project that generates profit with its share sukuk holder. In Indonesia, sukuk widely used because they meet the needs of investors who acquire Islamic finance person, and they expand our funding option for issuers. Fifth, mutual funds or reksadana. Yeah, we know about it. It's the safe place we got our bonds, our money to save the crowd without risk. Six, exchange trade fund (ETFs). ETFs are similar to mutual funds, but trade like stocks on the exchange. They often track an index or a sector, providing low cost, liquid access to market segments for investor. ETFs combine diversification in trading flexibility. 7. Derivatives, such as futures and options. These are contracts whose value derives from an underlying asset, a stock, index, commodity, or bond. Derivative is used for hedging, for example, protect against currency or price swings, and for speculative strategies. Like buying futures, you can go with 10 leverage or 15 leverage. This is like the derivatives. 8. Right issue and warrants. A right issue lets existing shareholder buy additional shares at discounted price before the public. To raise more equity while giving priority to current owners. Warrants are long-term debt option attached to securities that permit holder to buy shares that set a price in the future. Both are tools for corporate financial investor enhancement. Okay, thank you for watching. Bye.